Maverick traders, welcome out to your trading room as we prepare for the week ahead, which will be June 30th through July 4th. Now remember, markets will be closed next Friday, July 4th for the holiday. Corey here with you. We're going to take you through meaningful news that happened this week. We're going to talk about broad markets and score the market, score the sectors. And as always, we're going to highlight our very best trade ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so as we look at last week's events, lately there is a lot of news. So markets touched a new all-time high and actually finished at a new all-time high, although there was some intraday news that kind of shot the market down and then it recovered and they bought the dip. We used up a lot of fuel just to get here. Of course, markets move off of supply and demand, and there has been a lot of demand, a lot of pushing of stocks higher as the buyers come in and the short sellers close and cover. So the question is, how does the market behave here? Do we pull back and create more of a cup and handle, or do we just have an immediate breakout? Israel, Iran are now in the midst of a ceasefire. There's debate about the severity of the nuclear program damage and what this does for Iran, but what is certain is that the markets are taking this as a positive in that things did not escalate further. They're looking at this and saying, okay, Iran retaliated the same way they did previously, notifying the U.S. before they sent some missiles and damaged some U.S. equipment, made sure that no U.S. citizens were going to be killed in this and so forth. And so that kind of tells you that Iran is not looking to escalate the situation further. Fed Chair Jerome Powell testified before Congress this week on both Tuesday and Wednesday. In the midst of that, Trump was holding his own press conference and really had some nasty words to describe Powell. Powell says we're data dependent, inflation concerns persist, and they noted that they were going to be watching different inflation gauges. Well, the PCE came out on Friday and it was a little bit higher, although PMIs beat. So as we look at the data, here in the U.S., we beat on both manufacturing and services PMI. CPI in Canada ran a little bit hot. CPI in Australia was a little cold, less than expected inflation. U.S. GDP finished, this is the final number, we went down 0.5%. So we had negative growth. We had a slowdown in the general economy quarter over quarter, a little worse than expected. Expected to come in at minus 0.2, came in at minus 0.5. And like we said, core PCE, which is a Fed watched inflation gauge, a little bit hotter than expected, came in at 0.2. Now, does this derail the Fed from cutting rates in the future? No. But this is what they're most watching. They have a dual mandate to keep full employment and to keep price stability, and they really screwed up price stability previously. We saw a year where inflation ran at 10-ish%, and they just don't want that. That is a big problem. It widens the wealth gap. It does all sorts of unintended consequences that they don't want. As we look at markets, well, the performance this week was stellar. Dow, S&P, NASDAQ, Russell, all up over 3%. In the case of the NASDAQ, up 4%. Gold got hammered, down 3%. But if you think it was bad for gold, look at oil, down 12%. Now, as these bombs were going off, one would think, oh, well, this could escalate. They could shut down the Straits of Hormuz, etc. All of those were possibilities. All of those did not come to fruition, and the oil market is reacting accordingly. I thought it was very well said when someone looks at oil and says, well, oil's price coming into this week was either $10 too low per barrel or $10 too high. If there's no escalation, you're going to see oil get hammered. And if there is further escalation, you're probably going to see oil skyrocket. So it was one of those times where volatility was very likely in oil, and with no further escalation, we saw oil take it on the chin. As we look at the S&P chart here, you come up to the resistance and you're essentially at resistance right now. Now, we could say, well, aren't you breaking out? Well, sort of. We did close higher. We did have a weekly, this is our highest weekly close on record, our highest daily close on record, and so on. So, but one day does not really exactly a breakout make. There could still be a little choppiness in here and then maybe some correction. So possibilities. Well, you've come up to resistance, and this just seemed like a target. Didn't it seem like there was a gravitational pull for markets to get back up to that resistance zone? This is the level that everyone was watching, and that's really how support and resistance works. So we had this big decline, mostly tariff related. Now we've had the huge recovery. We've used a lot of fuel, a lot of demand just to get back up to this level. You could back and feel, and that would be the handle, right? The cup and handle. A lot of people look at this price action, they say, well, might it be a double top? I just never plan. I adjust if it is a double top, but every time you think it's a double top, there's 10 cup and handles for every one double top type of dynamic. So usually these are continuation patterns. You may get some back and fill here, but ultimately it would seem that we would push to the upside. And there's an old saying, a question, is it a good idea to buy the market at new all-time highs? And the answer is no, it's not a good idea. It's a great idea. And so the reason that buying at new all-time highs is a great idea is what follows a new all-time high. More all-time highs and more all-time highs. When the market's at new all-time highs, it usually sustains that for an extended period. In some cases, for years, you will continue upward overall, big picture. Now, what this doesn't suggest is whether you should buy within the first couple of days of attempting to make a new all-time high. I would allow the market to really break out before getting too optimistic in the very short term. Again, I think we're just at that point, sort of like oil last week. It's probably not a good price at 6,200. Either it's going a couple hundred points higher or it's going a couple hundred points lower in the very short term. Just not quite sure whether it's going to hold this level or really break out. Now the NASDAQ, same thing. The NASDAQ has pushed above the resistance zone. I mean, the breakouts seem like they're happening. Could we extend a little further? Absolutely. I wouldn't discount that as a possibility, but ultimately I would like to see us clear this level, and then you could say, hey, we can rally for the coming months. We could rally for the rest of 2025 and have 10% more of upside in the broader markets. Look at this weekly heat map, a lot of green. Really the most important companies with the brightest green, the only exception maybe being Apple as a laggard. You saw the energy sector, as would be expected, got absolutely hammered this week. Down sharply, and that's going to happen if oil is down 12% for the week. Usually buying stocks at new all-time highs is a great idea, but not necessarily on the initial test and on the initial break. We want to see clarity. It's okay to allow things to really break out for a week or two before getting all bulled up and saying, hey, all signs are clear and away we go. If we do correct back and create a little cup and handle, if this is a little bit of just a retest and not a true break, you don't want to be all bulled up into that scenario. Risk on weak overall, as you saw oil and gold get hammered. You saw risk assets like stocks go sharply higher. Tariff deadlines are coming up. There was news over at the end of the week that China and the U.S. have struck a deal on tariffs, or at least as it pertains to some of the rare earth materials and some of the technology things that China has in place. The deal with Canada is on hold. Basically, talks have broken down, and this was what caused some intraday sell-off in the S&P, and then again they bought that dip back up. So as you look at price action, as you look at the market here, I think technically is more important than what's here on the economic calendar. But Fed Chair Powell will speak on Tuesday. We get some ISM manufacturing numbers. This is expected to come in below 50, which would be a recessionary type of number, a slowing type of number. You've got non-farm payrolls, but note the date. The payrolls always come out on the first Friday of the month unless the first Friday of the month happens to be something like the 4th of July. Markets will be closed, bank holiday, etc. on Friday. So Thursday is the end of the week, and non-farm payrolls will come out Thursday morning instead of Friday morning. Also worth noting, if you're trading options, then Thursday becomes the final trading day, and Friday again would be where the options would settle, and there is no trading available on Friday. Markets will be closed at that point in time. As we look at our weekly and monthly outlook, we're getting to the point where the S&P, the slope of the moving averages is starting to separate. We're potentially breaking out. This weekly outlook of zero is almost the worst outlook because I'm pretty convinced we're going one way or the other, just not sure which direction. I would almost have to think that maybe, just maybe, we're going to get a little bit of a correction back down. So let's take a look at some sectors here. As would be expected, this weekly performance was fantastic. It was lights out for the markets. So for the week, you can see comm services up for consumers and financials and industrials and technology and all these that are dependent, what we would call cyclicals. They're impacted by the economy. And all of these sectors love it when, frankly, oil prices go down, right? This is a big cost. This is an expense, paying for oil and such. So this is a perfect day for the markets, really, in terms of just the economy and so forth. Now, some of these sector charts seem to be a little screwed up. I couldn't get the rest of the data, but you can see enough here to know that XLU is in a sideways pattern. There's one other sector chart that's a little messed up here coming up. Communication services, strong as can be. Some separation happening in the moving averages. Upgraded this one to a +3. Comm services just look fantastic. If we go to real estate, this one gets a little bit of a downgrade. You can see that real estate is now breaking below some moving averages. It's not really in a downtrend, but it's not upward trending either. You'd really have to call that just a consolidation. Healthcare is a little bit more consolidating slash possibly rolling over. So those moving averages are squeezing together, and what often happens here is the separation that goes this way. So I would be leaning more towards healthcare being bearish out of this type of pattern. This is a nice consolidation, but this is about the point of where you get a reversal. Industrials, this is the other chart that was a little messed up, but clear breakout, strong as can be. Industrials look fantastic. We've got financials just starting to break out. Notice the resistance zone back here, and like the S&P and such, starting to just cross above that. So really good looking chart there in financials. We've got that at a +2. Consumer discretionary, this one hasn't quite broken out like financials, but certainly on the cusp of that. So same type of idea. If we were to draw in the lines, you're essentially right at that prior resistance zone, and maybe, just on the cusp of a breakout, but not far behind, and we'd have to give that a more bullish reading as well. XLP, which is consumer staples, this looks pretty bad when you've got a stock market booming, but this is defensive. This would be an area that people hide out in when they want to play it safe and collect dividends and so on, not when they want to be aggressive. Well, money's flowing out of that recently. A little bit more negative price chart in consumer staples. Tech still looks solid. You'd say this one already broke out previously. That's where you get the really bullish reading. Things that have already broken out ahead of the market, their leadership groups. Material stock, not breaking out yet, not really on the cusp of it. It would take a little more push to get back up here towards the resistance zone, but not far off either. So energy, I've got it downgraded at more of a zero, back into the consolidation zone, back into this area, and likely to stay consolidating. So if we stack up the sectors, we've got comm services, industrials, and technology leading. Financials not too far behind. Materials, consumer slightly positive. Utilities, energy, and real estate flat. And staples and healthcare, the defensive sector, certainly the underperformers. All right, so as we come in and look at some trades rolling off, we're losing a financial, a consumer staple, and a technology trade as we've hit expiration. What we are looking at from a market scoring perspective is still more bullish. Now, for the next week or two, it might back and fill a little bit. That wouldn't be out of the question. That's actually pretty normal price action. If you use this little consolidative phase over here as an example, you often create a little symmetry and something similar to that on the other side. So similar in size here would be similar in size here to the consolidation and the correction. That makes me bullish, but understanding that we could chop around a little bit before we get the big clean breakout. So markets still bullish, certainly more bullish than not. We have it at a +2 market perspective, on the cusp of a +3, certainly. So if we look at our desired trades, we're going to add a couple more bulls to the mix. We've got a technology, we've got a financial coming in, we've got a healthcare on the bearish side. I wanted to just have something over there. Normally with this type of outlook, we'd have some bearish trades. We're going to add one in the healthcare space. So let's look at possible trades here. The first sector is healthcare, which is a more bearish sector. AbbVie broke down, and similar to what we saw in terms of the reversal of certain sectors, right? Energy, when it sold off and it had a big expanded range bearish candle, bearish engulfing formation on massive volume. Well, AbbVie had all of that. If we were to look at this chart a little more closely, you have essentially a symmetrical triangle, a consolidation pattern here that we are breaking out of, and we are breaking to the downside. They often call this a volatility compression pattern because you're getting pressed, squeezed into the funnel. And when you break, you often have an expanded move. So in the case of AbbVie, we see the bearish possibilities. We're just going to play it as a bear put spread. Simple bear put debit spread. If we buy the 182.50 put and sell the 177.50 put in July, we're going to get a reward that's quite a bit greater than our risk. Now, in a perfect world, AbbVie would gap up just slightly on Monday, and we can initiate that trade at a very low price. We want to pay as low a debit as possible. That will reduce our risk. It'll increase our reward. It would be perfection as far as possibilities here. So not a massive gap higher, just a small gap higher on Monday morning. We'll get a little bit better price fill. On the bullish side, we'll look at financials first. JP Morgan, not too much to say here. If we look at the chart, you had a long extended base, and the larger the base, the larger you go in space. And this thing looks, to my eye, like it's headed towards 300, a psychological level of resistance. So if I look at JPM and I'm bullish, well, we can similarly, what we talked about with uh, a, a debit spread in AbbVie, well, we're going to do a debit spread in JP Morgan, but the difference is now we're bullish. We're going to buy a call spread. We can buy the 287.50 call, sell the 292.50 call. Again, excellent risk to reward here in the case of JP Morgan. And if this is in fact working its way towards 3,000 in the short term, it certainly has to get above 292.50, which is the ideal spot that it finishes above that on July 11th expiration, and we would have a max profit in that case. So we want to see that stock trade higher once we've initiated that position. And last but not least, we've got the technology sector represented. Here's Datadog. This high basing pattern, you just look at the price action, and again, it's so strong. The thing I like about high bases, when you think about the psychology, is when something's so strong that it's not even weak enough to pull back to the moving averages, that it keeps separation. It's okay if it does, right? But it speaks to how strong it is, that even though it's kind of in a resting phase, it didn't rest downward, it rested sideways. And that just tells you that there's an insatiable appetite for Datadog shares. And so we think, well, in that case, we want to profit from even higher prices when inevitably more buying pressure would likely come in. So we're looking at July 18th expiration, just 1 week out further, buying the 133, selling the 136, bull call debit. All we need is for it to finish above 136 on July 18th, and we would have a max profit. And again, in this case, we want to pay as small a debit as possible to improve our reward to risk ratio. So 3 potential trades, all vertical spreads, debit spread opportunities. Is this going to cup and handle, or do we just go straight to the breakout? It's a strong enough market, you can't discount, even though cup and handles normally happen. Normally you'll get some back and fill. Normally you'll have some correction. This is a little different market environment we're dealing with. So maybe, just maybe, we're going straight through. Calm before the tariff storm. Again, we've got some significant dates coming up. Use proper position sizes, manage your risk, and over time, you're going to be in a much better place as a trader. Hope you enjoyed this week's Trading Room. We'll be back next week with another one. We'll see you next time.